Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right, my name is Mark Eitel, and this is the Mr. Mortgage Show. And friends, you're in the right place if you are confused, if you are frustrated, if you're just pulling your hair out because you can't make sense of any of this data. What's going on with the real estate market? Is this house of cards finally going to come tumbling down, or does it still make sense to buy or sell? Guys, we're going to cover all that. We're going to deep dive the data. We're going to answer your questions and give you the real inside info, not the headlines, but the real data, the tips, the tricks, the strategies, and all the info that you need so you can go out and make better real estate and mortgage decisions for you and your family. And buckle up. This is going to be a good one. Lots of great data was released this week. A lot of it contradictory to one another. I don't know. You almost need a crystal ball to figure out what's going on. No crystal balls here, guys. We're just going to dive through the data and do our very best to make sense of all of it for you. Hey, if you've got questions or comments along the way, just give us a call or shoot us a text. And you can do that by dialing 855-462-7292. That's 855-462-7292. That is the Anytime hotline. Jen is womanning the hotline, and she will get your questions on the air. If you prefer to shoot us an email, you can do that too. Just head on over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way also. She'll read them on the air for you. But guys, as I mentioned, a lot of data this week. Found it super, super interesting because it was a couple weeks ago that we talked about the article that was on CNBC, that data set that was released showing that mortgage delinquencies, which are the precursor to a default, which is the precursor to a foreclosure, just recorded their second lowest month in history, meaning this big wave of foreclosures that people keep talking about still is yet to materialize and unlikely to materialize anytime in the near future because of that delinquency number. So we talked a lot about that. And in the subsequent weeks, there's been everybody's version of that report now released. Redfin just released it. And because of that, I got into a conversation / debate / interesting dialogue with a group of realtors that I speak with quite often. And we were talking about the importance of understanding the numbers, I guess was a byproduct of the conversation, because some of the agents were talking about how this must be different in their market because a headline was just released showing that foreclosure activity increased by 20%, 25%, whatever the number was. But guys, if the foreclosures are 2 for that month in that zip code, and now they're 4, well, that's a doubling of foreclosures. And if the headline reads foreclosure activity doubles, well, that's super, super scary. But if there's historically 40 and we went from 2 to 4, we're still at a ridiculously low number by historic standards. And we have not established a trend yet, and we've got a long way to go before foreclosures are bringing enough inventory to the market to push downward on pricing. So pricing is still, as always, I've said it for years and years and years, and people think I'm crazy. Supply and demand is the only thing that controls prices. The only thing, not interest rate, not economic condition, supply and demand. Now, those other things can affect demand, and that's the intent of the Fed, is to cool demand on major purchases, or any purchases for that matter, by increasing interest rates. But we're just not seeing the effect of that yet. So right now in this market, even though another interesting data set was released this week, that mortgage applications fell to their lowest in 3 months. Well, no surprise there, because mortgage interest rates increased to their highest in 3 months. And there's a direct correlation with the cost of money to the desire to borrow it. So even at the reduced application pace, there's still more demand than supply. And we're seeing it. You can see the headlines. You can see the comments on Facebook that, there were 5 offers on this property, 15 offers on this property. I talked to an agent in the Northeast, and she had 16 offers on an open house, and it was sold under contract 3 hours after the open house closed. So because of the supply and demand equation, prices are still holding, and there's no indication, foreclosures being one more place, that there's just not a lot of supply coming to the market. And the number one driving factor is interest rates. People don't want to sell and give up a low interest rate and then go pay a higher price and a higher cost of money for arguably the same home. Most people couldn't buy the home that they live in right now today if they had to. So I just find it fascinating. We hear that term rate locked. People are locked into their home because they don't want to give up that low interest rate. And we're seeing, I find it interesting that the Home Depot and Lowe's retail forecasts were down because we're starting to see an uptick in people wanting to renovate their homes. And you would think that those two retail powerhouses would be a direct beneficiary of it. And maybe this is such a leading indicator that they haven't experienced it yet, but we're seeing people that are wanting to do cash out refinances for home improvement or equity lines to pull some equity out for home improvement or debt consolidation. And that's one more big thing that I think is going to hold back any foreclosures in the near term, if you will, is because people have so much equity. We're seeing people pull some equity out and pay debt off and reduce their overall monthly expenses, even though their interest rate is going up, and they're kind of, planning for this recessionary winter, if you will, and they're packing some food in the freezer, putting a little cushion in the bank and paying off all their debt so they can ride through it. So it's interesting when we see all of these different contributing factors and data sets and how that adds up into a housing trend, if you will. And we have access to a lot of interesting data on this show. So I wanted to share this one article that I pulled this week from CNBC because we were just talking about equity extraction for home improvement. And the 3 places that people are getting the most bang for the buck are not the beautiful kitchen and beautiful bath upgrades, but it's the HVAC, the doors, windows, and siding, right? So the structural components of the home seem to be the most valuable component. So I find that interesting because we go in there and want to slap a bunch of lipstick on it and think that's going to instantly make it more valuable. So if you want to check out that article, go to mrmortgageradio.com and click on that Facebook page. So there's some good stuff there. I posted an article too about how this higher interest rate environment is actually benefiting some people because they have a tendency via a higher interest rate to earn more on their investments. And we're seeing that in real estate with seller financing, and we're seeing it across the board with other investment vehicles, although the expenses associated with living are far higher too. Not everybody gets mad at high interest rates nor high prices. So anyway, guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the show.
Have you recently experienced a shocking rate increase on your homeowner's insurance policy or received a dreaded cancellation notice? It feels like you're being priced out of your own home, doesn't it? Well, worry no more. Introducing HOIPolicyReview.com, the website designed specifically for people like you. We understand the frustration and financial strain these situations bring. That's why we're here to help. With HOIPolicyReview.com, all you need to do is provide us with a few details about your home and current policy, and we'll take care of the rest. Our team will tirelessly compare dozens of carriers against one another, ensuring you receive the best quote possible. Don't let rising rates or cancellations force you out of your home. Visit HOIPolicyReview.com today to take the first step towards securing the insurance coverage you need. So don't wait any longer. Go to HOIPolicyReview.com and get started today. Remember, we're here to help you find the insurance solution that fits your needs. That's HOIPolicyReview.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, we are going to dive right into your questions. Super excited to get this part of the show started. Always my favorite part. But hey, we threw a lot at you in that opening segment. So if you've got questions or comments, give us a call, shoot us a text to 855-462-7292. 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is womanning the hotline, and she will get you on the air. I know she's already taken a couple calls, so we must have struck a chord with something in that opening segment. So I'm excited to dig in and hear what your thoughts are anyway. If you prefer to shoot us an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. But as I mentioned, there are some questions already on the board. I see her back there busily at work, and she's not smiling at me right now. Anyway, let's toss it over to Jen and get the first question of the show on the air. Hey, Jen, what do you have?
Raphael sent us a text. Are doctor loans still available? I remember hearing about them a couple years ago while I was still in school, but I'm getting mixed messages now.
Hey, Raphael, that's a great question, my man. Yeah, we don't get that one often. It's interesting because they are a great loan program for anybody who's recently graduated with a medical degree in a medical field. So doctor loans work for dentists, ophthalmologists, optometrists, obviously any medical doctor. Did I say veterinarian? Because that one often gets overlooked. But to answer your question, yes, they are still available. Some of the guidelines have been tightened a little bit, but in case somebody out there is curious and they don't know what Raphael and I are talking about, a doctor loan is a loan program designed to allow a doctor to borrow. It used to be up to 100%. There are some programs within certain parameters you can still get 100%. Most of them are 95 right now, but a high LTV up to 100% with no mortgage insurance, which is a big one because the mortgage insurance component is expensive when you're at that, 95, 97, and in this case, 100% loan to value. So that's one of the biggest benefits of the doctor loan. And then underwriting the student loans that are in deferment, there is some advantages with the guidelines there as well. So, and student loans are an interesting debate in general right now. An interesting conversation, I guess. I don't know debate, but fascinating conversation right now. So, but anyway, Raphael, doctor loans do still exist. We've got a half a dozen or so varieties of that particular loan program. So if you need additional information or you want to have a little deeper discussion, I encourage you to reach out. I'll be happy to help any way I can. But I appreciate that one. That's a good one. Yes, indeed, doctor loans are still on the books. Hey, Jen, do you have another one?
Richard is asking, can you give me a quick overview of the pros and cons of a reverse mortgage? I think we may be ready. How do we make an appointment to talk to you directly? Thank you.
Hey, that's a great question. So you can just call 855-462-7292 or visit MrMortgageRadio.com, and there's a link there that says more about reverse. If you go to that page and just fill out that little information card, we'll set up an appointment and take all the time you need to get comfortable with the decision, because it's a big decision, guys. The reverse mortgage is an amazing loan program. And we talked about some people benefiting from higher home values and higher interest rates. The reverse mortgage is a place where people are benefiting greatly from the higher values of the property because suddenly they have a ton of equity. Not so much the higher interest rates because it's costing them more to borrow. But in this case, that big rapid appreciation cycle now is a great time to pull out equity, and a reverse mortgage is a great way to do it if the circumstances line up for you. Because as I mentioned, you hear me say it all the time, it's not good or bad, it's just a tool. And used properly, it can make a huge improvement in someone's life. A hammer's a tool. I say it all the time. You can build a house with a hammer, and you can tear a house down with a hammer. So the wrong tool or the right tool in the wrong hands rather can cause some harm. So I'm always encourage everybody to take the necessary time to fully understand all the pros and cons. But here's an overview so we can answer the question and kind of get it out there. And then if anybody wants to go set up an appointment and dive a little deeper, I'm happy to have this discussion. I got involved in the reverse space because a family member of mine was investigating it years ago, and I dove in head first and got certified because I wanted to understand everything I could because I didn't want them to make a bad decision. So anyway, here we go. The biggest myths around a reverse mortgage are that you no longer own your home, that you sign it over to the lender, which is not the case. It acts like any other mortgage instrument. It's simply a lien against your property. You owe someone else some money, and they have a lien against your property until it's paid. Just like if you went out there and borrowed, money to buy a house. It's exactly the same structure. You own the property, and the reverse mortgage lender has a lien against the property. So you still own your home. Another very, very interesting part of the reverse mortgage is it's non-recourse. So if property values tank in the future and you owe more than the property's worth, there's no recourse on you or any of your heirs. If the property's upside down, your kids can just slide the keys across the table to the bank, and the bank deals with the loss because the loan program is insured. It's part of the FHA suite of loans. So the lender's insured against loss, so it does not pass on to you or to your heirs. You can't be forced to sell the property if you eat up all your equity, either because property values have a downturn or you outlive the projections when they set the reverse mortgage up and now you owe more than the house is worth. They can't force you to pay it off. They can't force you to sell the property. You're there until your death or you choose to move. That's another thing. There's no prepayment penalty. You can sell that anytime you want and pick up and move. So ton of interesting components to the reverse mortgage. We could do a whole show, and maybe we will do a whole show on it because it certainly merits it. But that is a great question. Hey, anybody who has questions about reverse mortgages, check out MrMortgageRadio.com. Click on that more about reverse icon and request the info pack so you can get a better understanding. But guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. And friends, you are in the right place if you are confused and frustrated and have questions about real estate and mortgages. Guys, we do it each week right here, same bat time, same bat station, and certainly appreciate you coming along for the ride with us. Man, I'm super excited every time I get to jump behind the mic and answer your questions. Hey, and if you have questions, please feel free to shoot them over. You can call or text 855-462-7292. That's 855 462-7292. That's the Anytime hotline, and Jen will get your questions on the air. Hey, if you prefer to send an email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. And you guys heard me mention it a little earlier in the show, mrmortgageradio.com. Ton of useful information there, links to all of the data sets that we talk about each week during the show. So if you ever want to deep dive or engage with us when we're not on the air, you can always check out mrmortgageradio.com, hit that Facebook page, check out the data sets for yourself, and feel free to reach out with questions or drop comments below some of the posts. I look at it every day and I'm happy to engage, and always willing to jump on the phone, answer any questions that you have, and help any way that we can. Guys, we are way more than a radio show. My team is nationwide, and we help families with their mortgage needs everywhere but New York. We're still working on New York, but the other 49, we got you covered right now. So if you've got questions, you need help, we're here. We're happy to help. So anyway, speaking of questions, that's why we are on the air today. Let's throw it over to Jen and see if we can get another question on the air. Hey, Jen, what do you have?
Juliet sent this email. We've gotten ourselves in a tough spot and want to refinance to pay off our bills and have a little cushion. But what happens if we refi and property values go down? Can the mortgage company change the terms?
Hey, Juliet, that's a great question. You know, I never really thought about the misconception about that. You know, that's interesting that you bring that up, because with an equity line of credit, the bank can change the terms because it's based on the equity. So if you run out there and you get a HELOC and suddenly property values go down and you've got some availability on your HELOC, you might get an unwelcomed phone call saying, hey, we're closing your HELOC or reducing the available credit on your HELOC because of market changes and the influences of that market change on your equity position. So brilliant question. The cool thing about a mortgage, and we talked about reverse mortgages a minute ago, the same thing applies to a forward mortgage. Once that mortgage is underwritten and funded, the terms can't change. Unless you default on the loan, that's it. You've got the money and that's your payment. Keep making that payment, and there's nothing that the bank can do to change those terms. So brilliant question. But to answer it in summary, if you do a cash out refinance and the property value goes down in the future, that cash is already yours. You know, that's your money. They can't change the terms, and they can't ask for a principal reduction. That's it. Everybody's got to live by the terms of that loan. And guys, we saw that during the housing crash of the early 2000s. You know, people owed twice as much as their property was worth for a minute, and they kept on paying, and there was nothing the bank could do except hope for the best. And they paid that loan off. And you know, since then, the property's appreciated considerably, and they ended up long-term making a ton of money in the form of equity. So brilliant question. I hope that made sense. I hope that answers your question. But if you need more information, I always encourage you to reach out. We're here and we're happy to help. Hey, Jen, do you have another question ready? Okay, go ahead.
Kelly sent us a text. I think you've talked about this before. Is there a special insurance policy for a house that needs a new roof? We're selling, and I know insurance is going to be a problem.
Hey, Kelly, that's a great question. You're right. I've talked about this a lot because insurance is such an underappreciated component of real estate. And we're seeing what's happening to people's policy premiums right now. Man, oh man, policy premiums are jumping across the country. But anyway, to answer your question, most likely what I was talking about was a builder's risk insurance policy. And the easiest way for me to explain that is to share the most recent story where a builder's risk policy made the difference. So you mentioned you're selling a house that likely needs a new roof. And in Florida in particular, in the hurricane belt, if you will, roofs are becoming more and more of an issue. In Florida, primarily because of the litigation around fraudulent roof claims for insurance companies. But that's a whole nother conversation. The system was abused and people are now paying the cost of that in their premiums. But because of that, most insurance companies don't want to insure a property that has a roof nearing the end of its useful life cycle. So here's the scenario that we saw. Seller selling a house, reduces the sales price because he knows it needs a new roof. He just doesn't have the money to put a new roof on, and quite frankly, he didn't want to do it just to sell the property. It takes weeks to get a roofing contractor to start, tens of thousands of dollars of expenses, all just to hopefully break even on that roof endeavor when he sells the property. So he's selling it as is. Roof's $20,000, reduces the price by $20,000. The buyer is thrilled. He's buying the property, getting a slight discount, gets to pick out the roofing material he wants. He's going to put the cool metal roof on the house, everything. Couldn't be happier. Here's the problem. He can't get insurance on the house because the roof is too old. And he doesn't want to pay for the roof before he owns the property. And the seller's not going to pay for the roof before the property closes. So we have this, catch-22, if you will. Well, dun-da-dun-da-dun, in rides a builder's risk policy. And the builder's risk policy insures against loss in front of the homeowner's insurance policy. So what happens is the builder's risk insures the property during that construction period. And because that builder's risk is in place, the insurance agent could bind a homeowner's insurance policy behind it. Now, the caveat is, in this instance that I'm speaking of, they had 6 months to get that roof on, done, inspected, or it would have caused a problem. Had that roof not been done and the builder's risk policy expires, the homeowner's insurance policy would have canceled. But that's the workaround. A builder's risk policy will buy you that time, if you will, to get the roof replaced on the property. So insurance just doesn't get the attention it deserves in a real estate transaction. I mean, I can't tell you how many times I've seen an initial quote come back and kill a deal. I'm thinking of one right off the top of my head. The quote came back at a little over $5,000 a year for a $275,000 home. And suddenly the borrower no longer qualified because, that's $400 and some odd dollars a month in insurance. And we had that policy re-quoted and it was $2,700 and change. And then boom, everybody's back on track and happy to move forward. The deal closes, everybody's happy. So insurance is a place a lot of people could use some help. And guys, if you need a good insurance referral, man, reach out. I'll be happy to help you any way I can and get you in touch with some of the people that we use because we're seeing it make a big, big difference out there. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this short break, we'll be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Friends, thank you so much for spending a bit of your day with us. We certainly enjoy having you along for the ride and diving into the data and answering all your questions. Hey, if you've got questions or comments, just give us a call, shoot us a text, 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. That's how you get your questions on the air. Jen is back there womanning the hotline, and she'll take care of you. 855-462-7292 or shoot us an email, and you can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. Always happy to get your questions on the air any way we can. Heck, tie them to the leg of a pigeon and point them in my direction. We'll get you on the air. But anyway, speaking of Jen and your questions, let's throw it her way and keep the questions coming. Hey, Jen, you ready? Go ahead.
Gerald is asking, I've heard you talk about a landlord loan. Is this similar to a hard money loan?
Hey, Gerald, that's a great question, my man. Hard money loans confuse a lot of people, and it sounds like it's a bad thing, right? Hard money. They're not hard to get. They're a higher interest rate, but to answer your question, no, they're not the same thing. A hard money loan is typically a private investor, right? Or a pool of private investors. Like I have friends who manage funds and they just do hard money loans. We do them all the time. We arrange transactions through their hard money fund. It's usually a lower loan to value, a shorter term, and a higher interest rate. It's short-term capital, right? It's, I need to get into this property the easiest way possible, grab some quick funds, close on the transaction, renovate it, and sell it. Or renovate it, rent it out, and then refinance it, right? Part of that BRRRR strategy that we talk about a lot. Buy, rehab, rent, refinance, and repeat. Sometimes that first mortgage in that equation is a hard money loan. But a landlord loan is a regular mortgage. It's not a conventional mortgage. It has far more liberal guidelines. It does carry a slightly higher interest rate than a conventional mortgage, but there are a variety of guidelines that allow easy access to the capital. The biggest one being if the property currently cash flows at a level that it supports the proposed debt, principal, interest, taxes, and insurance, and if there's any association fees, assuming that you can rent it and break even on the payment. In the world of the landlord loan, that's considered fundable. That's cash flow positive, even though it's break even. So we're just looking at your credit and looking at your asset position and looking at the property to produce the income. And vacant properties work with the landlord loan by utilizing the average monthly rents for that neighborhood. Also, Airbnb, we can utilize projected Airbnb income on a property. So the landlord loan is typically a 30-year mortgage. You may or may not have a prepayment penalty. You may or may not have an interest-only option. But unlike hard money, it's a 30-year term. The interest rate is usually lower than hard money, and the fees associated with closing the transaction are often a little bit less. So if a conventional mortgage is, the first step, then a landlord loan might be the second step on the equation to hard money being on the other end of that extreme, if you will. I don't know if that made sense. I don't know why my mind went through that, but it's kind of middle money, if you will, between conventional and hard money might be the landlord loan. But great question. I hope that helps. And if you need more information, we're funding them all the time. They're an amazing tool to utilize to buy investment property. So great one. Appreciate that. Hey, Jen, throw me another question. Okay.
Lee sent us this. I currently have an FHA mortgage. Can I do an FHA cash out refinance? Do I have to get another FHA? Is this a bad idea? That's a lot of questions, Lee.
A lot of questions indeed. I'm going to start with, is this a bad idea, which was your last question. I don't know that. I don't know until I know the circumstances around you wanting to pull cash out. If you're suggesting it may be a bad idea to go FHA to FHA, I don't know that that's the case. But let me start in the opposite order so I can stay on track here. Jen doesn't like it when I break protocol. So,
Mark.
Anyway, yes, there is a cash out refinance for FHA. A lot of people are familiar with the streamlined FHA refinance, which is just designed to lower your interest, right? Well, cash out FHA loan requires full underwriting, full documentation. So don't confuse it with the streamlined loan. It's capped at 80% loan to value. So If you have enough equity that at 80% of the value, you can pull the cash out you need, then the FHA cash out refi may make sense. One of the downsides is, even though you're at that 80% threshold, the FHA loan will require mortgage insurance and will always require that mortgage insurance. Now, the FHA loan carries a lower interest rate, and they have recently reduced the cost of the mortgage insurance, so it still may make sense compared to a conventional cash out refi, but just know that going in. So oftentimes, apples to apples, a lot of people prefer to go from an FHA loan to a conventional loan, even with the cash out component, and maybe you buy the rate down a little bit so the rates are comparable, and then you're not required to carry that mortgage insurance. So those are the big differences. You don't have to go FHA to FHA, but you can. And here's a fun fact, guys. You can have a conventional loan right now and do an FHA cash out refi. And the advantages to the FHA are the underwriting guidelines are more liberal. They'll fund against a lower credit score. They'll carry a slightly better interest rate. So there are some advantages, apples to apples with the FHA loan. And in certain cases, we have seen it advantageous to go from a conventional loan to a cash out refi FHA loan. So you asked a lot of questions and I gave you a lot of answers. I hope I didn't confuse you. And then lastly, I don't know if it's a good idea. I'm happy to sit with you and, let's discuss what your goals are. Why are you pulling this cash out? Is it debt consolidation? And then you're unburdening yourself from all of these other payments, then yeah, that's probably a good idea. If it's going to make your life better, or if you're pulling that equity out so you can access an investment opportunity. I'm not suggesting go out there and buy Dogecoin with it, but if you can pull your equity out and go buy an investment property, or what are you doing with that equity is the big question. Is that move you're about to make going to put your family in a better situation now and moving forward? Those are the fundamental questions that I ask. If you just, some people right now are pulling cash out because they're afraid of what's happening in the economy, and they just want to stick that money in the bank for just in case. And I don't have a problem with that. I love the idea of some just in case money, as long as you're disciplined enough that just in case money doesn't turn into a jet ski. That could be a brilliant strategy, because if you get through whatever perceived economic downturn might negatively impact you, you can always pay back down that principal. So there's a lot of reasons why people pull cash out of a property, even in a higher interest rate environment. Medical expenses, investment opportunities, unforeseen expenses. Your kid was uninsured and he crashed his car and now you got a big bill. Well, maybe I watched too much Judge Judy, but that's a place where capitalizing on some of that savings that you've built up in the form of equity could be beneficial. I've seen many people pull out cash to pay for uninsured medical expenses. We've talked about that in the past too. Building equity can only help you in the future, and having access to it can help you when you need it most. So I'm not against it. I don't know enough to know if fundamentally it's a good decision, but you have access to it in a variety of ways. And I hope that helps. If you need more information or you want to have a deeper conversation about it, just give me a call and we'll set something up. I'll be happy to go through it with you. But guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this short break, we'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show, and we greatly appreciate your participation. Guys, if you've got questions or comments, just give us a call or shoot us a text. The Anytime hotline is 855-462-7292. That's 855-462-7292. Jen, my producer, is womanning the hotline, and she'll get your questions on the air. Hey, if you prefer to shoot us an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and in real time, that email will pop up in front of Jen, and she'll get your question on the air. Hey, but speaking of your questions, I'm going to toss it over to Jen, and let's keep these rolling. We've had some great ones so far. Hey, Jen, what do you have?
Andy wants to know, my landlord just told me he's getting ready to sell my house. I've been here for 11 years and just re-signed my lease. Can I get kicked out if it sells?
Hey, Andy, man, oh man, we get this one all the time. Landlords are cashing out. They're capitalizing on this big surge in equity, and oftentimes they're selling their property, 1031 exchanging the profits and rolling it into 2 or 3 more purchases and using the landlord loan to do it. Guys, we've seen both sides of this. I'm getting calls from tenants, just like you, Andy, who are confused what's going to happen. Sometimes they want to try to buy the house that they've been renting or the condo, and we're helping them do that. And then with sellers, we're helping them orchestrate the 1031 exchange and then prepping them so they can close those 3 landlord loans at the same time. So brilliant question, and definitely a sign of the times, because a lot of people are faced with this right now. But to answer your question, I didn't mean to get sidetracked. To answer your question, no, you should be fine. So I'll be happy to read that lease for you and at least give you my opinion, or I can refer you to a real estate attorney if this gets contentious and they can help you. But typically what happens is that's a legal binding agreement that you have with the landlord, and the sale of that property, the new owner is obligated to meet those same fundamental principles of that legal binding agreement. They buy the property, the current landlord will transfer your deposit to the new owner. If he's holding escrow money for first, last, or security, that will transfer to the new owner, and the new owner is obligated to abide by the terms of the lease. But you don't want to do anything that's going to put you in default, because that would change everything. So typically the new owner is required to abide by the same lease. So you should have time. But if you want to have a further discussion about that, I'm happy to dive deep with you. And you're not alone in this. We're having this conversation quite regularly. As I mentioned, a lot of people cashing out in this equity-rich environment. So I hope that helps breathe a sigh of relief, because you're likely protected through the end of your lease term. So good luck, brother. If you need help, give us a shout. I'll help any way I can. Hey, Jen, throw me another question, would you?
Sharon sent us this one. This isn't a mortgage question, but I hope you can help. We just got a cancellation letter from our insurance company and have 60 days to get a new policy. Our insurance is part of our mortgage payment. Do we call our mortgage company or an insurance company? I appreciate your advice.
Wow. Hey, Sharon, man, oh man, this is another phone call we're getting a lot. So I'm sorry that you're going through this, but again, a sign of the times, because we talked about insurance, a little earlier in the show. And a lot of crazy things happening in the world of insurance. So, but to answer your question, you will engage with an insurance company or insurance brokerage. So a lot of people don't realize that even though your insurance payment is part of your mortgage payment, they're just peeling that insurance piece off every month and putting it in escrow. and then paying it on your behalf at the end of that year, that period of time. So you're in full control of the policy. And this goes for anybody out there that wants to change insurers, for whatever reason. You just want to get a more competitive quote. You can contact an insurance company and set that up, and they'll contact the mortgage company. You'll want to let the servicer know you're getting a new policy, but then you can cancel the current policy, put the new policy in place, and it will still be part of your monthly payment. So you don't have to start with your mortgage company. You'll want to start with an insurance agent or insurance company and get that new policy in place. And guys, if anybody out there needs help with getting a competitive policy, check out hoipolicyreview.com. That's homeowners insurance, hoipolicyreview.com. That's an affiliation with the national insurance brokerage that can provide a competitive quote. So we're hearing this a lot, and we're doing our best to put some resources in place that people can benefit from. So brilliant question, and I'm happy to have a discussion with you off the air if you need some more help with that. But start with an insurance agent or insurance company, get that policy lined up, and then contact the mortgage company so they can make the transition smooth for you. But hate to hear that you're going through it, but I appreciate the question. Hope that helps. Thanks. Hey, Jen, do you have another one?
Mary sent us an email. Funny that you mentioned higher rates being good for some people. We don't currently have a mortgage and are considering to sell and offer seller financing. What should we watch out for?
Hey, that's a great question. And yeah, we talked about that in the opening segment of the show. There are a lot of people who are doing this very same strategy to convert their current property into cash flow because they don't need the equity. You sell the house and then you've got this big chunk of money. What are you going to do with it? You've got to turn that into cash flow because cash flow pays for gas and groceries. Equity doesn't. So brilliant question. And seller financing is becoming more attractive right now. So the benefits to the seller is these higher interest rates allow you to command a higher rate. And the benefits to a buyer is that perhaps they need the time to qualify for a mortgage. Maybe they have the cash. Maybe they can put the down payment down and make the monthly payments, but they're just not in the position to qualify. So brilliant question. The things I would look out for is I would essentially underwrite the borrower. Where is the money coming from? How are they going to pay it back? Do they have good jobs? Are they able to make these payments? And then I would ask for a large enough down payment to cover yourself if you have to go through the foreclosure process. So other options would be a lease to own scenario where you would still be the titled owner of the property. As the seller, you would have more control in that situation. So I'm happy to have a long conversation with you about it because I think there's a lot of strategies around this, but I would look for a large enough down payment to protect myself, and I would want to do whatever due diligence I could to make sure the borrower had the ability and willingness to repay, just like we do as a mortgage company when we're evaluating a borrower. So great question, and best of luck with that. Happy to help any way that I can. Hey, Jen, let's try to squeeze in another one.
Denise sent an email. I've looked at a few condos and really like a couple. I'm told the building is co-op and that I have to pay cash. What does co-op mean, and why can't I get a mortgage? Thank you.
Hey, Denise, that's a great question. So co-op is an ownership structure, and there are mortgages available for co-opt properties. And maybe whoever told you that's just unaware of it. Usually they require a little more down payment. Sometimes the terms only go out to 20 years. So they're a little less desirable compared to, like an FHA loan or a conventional loan, but they're available. Co-op is an interesting structure. So when you buy a unit in a co-op, you're not buying the unit, you're buying a share of, let's say that it's a building with 100 units. So there are 100 shares in the co-op, and it's like a company. Your one share is tied to your unit. So that share gives you ownership access to that unit, but you're essentially buying that share and not the real property. So it's a little confusing, and it's a little more difficult for a bank to foreclose. and that's why the lending on a co-op is a little more restrictive. Super popular in the Northeast, but they do exist everywhere. And it sounds like we could use a little more time to discuss this one, and I'm happy to spend some time with you. But I hope that answers your question. Man, what a great question to round out the show. Wow, guys, another week in the books. My gosh, where does time go? Hey, you hear the music? That means we've wrapped up another week of the Mr. Mortgage Show. Man, oh man, time flies when we're together. I love spending time with you. Hey, if you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. We're here. We're happy to help. If you can hear my voice, we could be your choice if you need a mortgage. MrMortgageRadio.com. Guys, have an amazing week. We'll be back next time right here. Same bat time, same bat station.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.